franchisees like Pizza, Motel 8, gas stations, Comfort Inn, and a whole lot more. Here's Jindal.
Thank you, everybody. So now we are approaching December. So in this is the perfect time to plan for your year end, so that you can do your tax planning. So that is the whole idea why we are in this business. We want to save the taxes for our clients. So how we do that? There's a checklist that we have prepared. So for businesses, you try to pay yourself a reasonable salary and your family members. That's called income splitting. So if you are in a higher tax bracket, if you break it down and give it to your family member, then that way you will, both will be in a lower tax bracket. Purchase capital assets before the year end. So if you are planning to buy the asset, let's say in January, why not buy in December? You will still claim the depreciation for the whole year. Consider whether you should incorporate your business. So if anybody here is self-employed, try incorporating it. So look at your total income. If your total income is just enough that you need that for your family expenses, living expenses, then maybe it's not a right choice for you. Otherwise, you can take the advantage of the lower tax rate of incorporation. However, you have to watch for the PSP rules. This is called personal service business. So if, for example, if you are working for only one customer and you don't have any employees, less than 5 employees, you fall in this PSP rules. So the government basically disallow the incorporation benefits. Pay dividends from your corporation. So dividend is again, the most tax advantageous source of income. So it's paid after tax dollars from the corporation, which is again a lower tax rate. And when you take the dividend and report it in your personal taxes, you get a dividend tax credit. So this is a very good tax planning. Consider paying out interest on shareholders' loan. So if you have taken a loan, from the CRA will consider prescribed rate and they will consider as a taxable benefit. So why not take the interest loan and take the deduction in your company? Plan for reducing your corporate taxable capital before year end. So you're basically there is a small business deduction that's based on your business income limit, and business limit is determined by the taxable capital employed. So this is basically for large companies who have over 15 million of taxable capital, and so try to minimize that. Purchase older automobile for your corporation. So let's say if you're using a corporation automobile for personal use, there are 2 types of benefits, taxable benefits arise to you personally. One is the standby charge, which relates to the cost of the automobile or the lease, and the second is the operating cost benefit. So if you buy that automobile in your name, so what will happen is the taxable benefit is not going to accrue to you, and you will buy it at fair market value. Whereas if you are not buying it and you're using it personally, so the CRA will take the cost of the original cost of the equipment and calculate all the benefits for you personally.